Welcome to Charting the Markets on this midweek trading session, Wednesday, the 27th of September. As we prepare to enter the last quarter of the year, there'll be some positioning taken over the next day or so. But I think it's worth looking at what's happening in terms of the general move in the markets as we see volatility cool off a little bit from those 1 month highs we've seen over the last 24 hours, which means that people are looking for opportunities to buy some risk assets. Now, the backdrop to this is that we've got a lot of warnings from many central bank members to suggest that, you know what, interest rate rises may be over. Possibly we might have one more. Neil Kashkari was talking about this yesterday, the Fed chief at the Minneapolis central bank. And he was saying that we are not too far away, but don't expect interest rate cuts anytime soon. I think this is something that the market's not really pricing in. Many are suggesting that now we've reached the top or very near so, that there's an opportunity here to get back into risk assets because interest rates are going to come down. And that's not the case at all. And I think people are not really pricing this in. But as we'll see in just a minute, we are seeing some efforts to go into risk assets in today's session, but it may all be to a longer term position, a contrarian position on the way down. Let's go first of all with what's happening on indices. I want to begin first of all with what's happening here in London. I think the London markets epitomise what's going on because we've seen the markets pull back in the last week or so. We're down back below the 200-day moving average. And we've hit this rising ceiling of resistance in the last week or so. And we've seen this pullback. But look at what's happening today. We've got this candle here on the way up. But I think this is just a retracement in what is otherwise a market that ultimately looks like it possibly wants to go down. Look at the MACD. Now, it's a little bit of a reprieve today, but I think it's just a question of time, possibly in the next few days, where we see this blue MACD line go below the signal line, the red dotted signal line. And that would be then when traders start to look for opportunities to get in on a better price to go short. And I think possibly that might even be what's happening in the session in today's trade. Now, for this, I think it's worth looking at what's going on with a Fibonacci. And if we draw a Fibonacci from where we are on the highs there to take a look at where we could well end up looking for that better price to go short, you can see here that from the high point we had back on the 15th of September to the swing low on the 25th of this month, where we saw that drop down to 75.80. You can see we're just about the 200-day moving average. Now, if this fails and we then on the way down again, then the short position does continue to be seen. In terms of the levels to watch out for on the upside, if we are going higher from where we are, we do have some resistance at 76.83, which is a 61.8% retracement on this Fibonacci, and that could well be the area to watch out for. So at the moment, many who are long on this market thinking that there's some upside to go. There may well be some further upside, but if we look at this as a technical move, that could be the area where we see some resistance. And I think then potentially we could well end up picking up on the downside. That's my base case on what's happening here in London. So despite the fact we've got a very strong candle today compared with what we saw yesterday, it might only be a short-term move on this way up. Same sort of thing happening on the German markets. We've got these big declines over the last couple of days. In the last week, we've gone below the 200-day moving average. We've dropped below the 15,455 support that was established with this candle back here, actually, on the 6th of July, and then again on the 18th of August at 15,455. That dropped yesterday. The candle closed on Monday below that, and then the entire candle yesterday below that. We've got some relief in the markets today, like we have in the London markets. But I think, again, this is just an opportunity for those that are looking as though they want to see some bottom fishing. But I don't think the bottom is over. And the German economy continues to score lower lows in terms of some of the economic data. We've seen some consumer numbers out today looking weaker and weaker as we continue to go on. And I think this is likely to continue. The ZEW number out this morning, it was actually down at 26.5. We've been looking for a drop down to 25, a negative 25. So I think that is just underscoring the overall epitome of what's happening on the German economy. Despite the fact we've got a rise today, I think longer term, we're short on these markets. If you are short on this, your stop goes above this line of prior support, now resistance at 15,455. So 15,464, 70 perhaps possibly maybe is a good point to put your stop loss. In fact, let's call it a nice round number at 15,500. That's where the stop loss would be if you are short on these markets, because the direction of the MACD and the direction of travel in terms of the background, I think, is quite negative. Let me just quickly catch up on what's happening on Wall Street for one of the main indices there, and this is the S&P 500. Now, this market yesterday had some big declines. Over the last couple of days, we disappeared below this line of support at 43.25. And this market continues to trade below that, despite the fact, like the other markets, we've got a little bit of bottom fishing going on today. But again, I don't think there's necessarily anything of any substantial upside to go on this. And I would, if you are short on this and you're still in the game, there's potentially more downside to go. It's a question of where we go on from down here. And let's take this as an example. That potentially is the next line of support to watch out for, 4103. Before we get to there, you have to go past the 200-day moving average, which comes in at 4200. So that could provide a little bit of support as well. But quite honestly, with that misreading of the markets, according to Neil Kashkari, about the fact the markets don't believe that there's another interest rate rise to come, and don't believe that interest rate rises are going to be around for a while here at these current levels. Markets just aren't pricing this in. And I think as we see more economic data to demonstrate that people are finding the going tough, we've got GDP out in the States a little bit later on this week. It's a second reading, but nonetheless, it's expected to see a little bit of a downtick, and that concerns many with the longer term outlook. So potentially further declines as we go out from this point on the indices, despite the fact we've got some interest at bottom fishing buying today. Longer term, there is this weakness in the markets. Let's take a look at what's happening on the foreign exchange markets on this midweek trading session as we continue to monitor this dollar strength. The dollar strength is really manifesting itself across the board, and you've only got to look at some of the major crosses. So for the euro dollar, for example, it's a really good example here, with expectations that the Fed is likely to stay high for longer in terms of the overall picture so far as interest rates are concerned. This drop for the euro is really all about that dollar strength. The dollar primacy is really making itself felt. And you can see this in the dollar basket, but it's just one of these crosses here, which is the major FX cross that people trade. The short trade is winning out. We've been talking about this in the early morning call now over the last couple of weeks. And it's just a question of bringing your stop loss in to lock in the profits on the way down. Where do we go from here? Well, we continue to march lower. In today's session, we've seen a new lower low, lowest trade we've seen there since the 15th of March this year. And we continue to tick lower. 105.66 is where we are. As of this Wednesday trading session, the next line of support is just below where we are at 105.16, but that looks very vulnerable. And you get a candle close below there. And then the next line of support is all the way down here on the 30th of November lows from last year at the 102.90 level. And that would be your price target if you're short on these markets. Continue to bring that stop loss in and you continue to build in profits into your trading position. Short as well. For the sterling trade against that far stronger dollar. But as I said, the dollar is stronger against the whole basket of currencies, as we'll see just a minute, against the Japanese yen as well. In today's session, a new lower low there for sterling against the US dollar, the lowest we've seen since the 17th of March. The Bank of England, of course, at the last meeting, left interest rates alone. Are we at the top here? Well, possibly again, but if we do stay here, in the next couple of meetings, the likelihood of interest rate cuts is not really upon us. That being said, there are concerns about the British economy, and suggestions are from the World Bank that the IMF that the UK economy could well be one of the worst performing in the quarters ahead, despite the fact we've got Germany in a very dark corner. The sterling is representing an economy which is in all sorts of trouble with political uncertainty as well. 121.48. The next line of support to watch out for is the 120 level, which were the lows we had here back on the 15th of March. Like against the euro, continue to bring your stop loss in on the way down. Now, this means we are long on dollar against those currencies where we got the dollar traded first. Dollar against the yen is a classic example of this, where we've got a continuation of the move up in the dollar against the yen, 149.04. Fundamentally, I think the 150 level is going to be interesting, because if we do get a pass of that, I think then the authorities could well come in and start to look in some more detail about how they're going to try and give some added strength to Japanese yen. Now, you'll see when we last were at these levels, the last time it was at 150, was all the way back in October last year. You remember then we saw the authorities come in to support the Japanese yen, and that then saw this trigger to pull the dollar back against what was then a stronger, or a yen that was strengthening, I should say. But we got the same sort of situation again. It's very difficult for any government, doesn't matter how much money they put into the market, the foreign exchange markets find their own level, and this is the level they're looking for at 150 for the dollar against the Japanese yen. If we do see a strike of 150, watch out for headlines from the Ministry of Finance or from the Japanese central bank or the Japanese government, or all three, as we could well end up seeing some sort of concerted effort to try and strengthen the Japanese yen. But at the moment, at least, we're still going long on this at 149.04. One of the effects of the stronger US dollar is that the dollar-denominated commodities are hit hard as a result of this. But it does mean that when you're buying it in a local currency, despite the fact we've seen some pressure for gold and so forth in the back of this stronger dollar, we do have some areas of the commodity markets where we are seeing gains. And one of those is the price of oil, both WTI and Brent on the way up for a second day in a row. Now, there's a fundamental reason for this, not just a currency trade, which is keeping the lid on some of the gains. But I think really this is all about what's happening with the supplies and the fact that US supplies for the shale gas storage, the Cushing storage in Oklahoma, is getting down to very dangerously low levels. And there's just not enough oil coming onto the market at the moment. So supplies are tight, which is keeping the upward trend on oil. So despite the fact we've got a shrinking dollar, it's causing all sorts of problems to the markets because the fact that the markets here are tight supplies, and this is keeping the pressure on the upside. Now, for me, there's further upside to go. There's just not enough oil coming onto the market. We're currently trading at 93.27 for Brent. If you're long on this, your stop goes below the underside of yesterday's candle or below the candle itself, down below the $92 level anyway, 93.27. The next line to watch out for are these highs up here, which are the highs we saw back in Tuesday, 19th of September, a week or so ago, at 94.98. You get a break of that, you're on the way up to levels not seen since the 11th of November. So to a degree, we've got the strength of the dollar fighting against this in that dollar-denominated commodity. But if you look at spot gold, this really is a function of that stronger dollar. And we've seen a disappearance below this symmetrical triangle pattern I've drawn on here, which when you look at the height of that, and you project that down, you've got a couple of interesting levels to watch. Definitely short is on the cards here, and if you're short on this, stop goes above recent price action to give you some protection. We're currently trading at 1895.5. The first line of support to watch out for me, is the low that we had here back on the 21st of August at 1884. Now that for me is the low point to watch, and that then took us back to levels not seen since March this year. But I think if we get a break of that, you're then on the way down to a completion of this pattern here, this height of the main part of the jaws of the symmetrical triangle. That projects you down to 1863, which would then become your new price target on a short trade, bringing your stop losses in, locking in the profits on the way down. You get a break of there, then there's not much, then supporting all the way down to 1804, which were the lows we had back on the 28th of February. So that, I think, is the next line of support to watch out for in terms of your price target on the way down for the price of gold. Let me just round off as well on what's happening with on one other commodity, and this is copper. Copper is reflecting, I think, possibly the fact we've got lack of demand coming through as much as anything else, despite the fact we've got a strong dollar also giving a little bit of a depression to the price. But we've got this pullback here. And this has been the price target, I think, since we had this little head and shoulders pattern. To be fair, the head and shoulders pattern was negated when we saw this rise up to the 200-day moving average. But nonetheless, just keeping that projection point in mind, that's the price target at 80.38. And my price target was always going to be 8,000 because that's a nice round number. And that's the lowest we've seen there since the 26th of May. So again, like all these other markets, keep on bringing your stop loss in if you're short on these markets, just to try and lock in some of these profits. But I think the message from today's trade really is what's happening on risk assets, with money going into risk assets at today's session. But I don't think that's going to last very much longer as markets wake up to the fact that we've got interest rates likely to stay at these high levels for some time to come. That's it for today's chart in the markets. I will be back with Angeline Ong at 1:30 p.m. today, UK time. I'll be taking a look at Google. It's 25th anniversary today of its listing as a fully fledged business back in 1998. I'll take a look at some of the big moves on the stock along the way. It wasn't listed then, but certainly the stock, when it did come to the market, it is a lot higher now than it was at that early listing point. But I'll be running through that. with Angeline. In amongst some of the other stocks to watch at the start of the day's trade, such as Costco and Micron Technology, a couple of stocks we'll be looking at, and how to trade those in the US markets later on. That's at 1:30 p.m. today, UK time, on the IG platform. Join me then.